Namaste, good morning. A session where we complete all the special cases except dissolution of a firm. We complete all the other special cases, and a session which is very important in terms of our examination and understanding. Also, I'll tell you why. So, yesterday we were looking at liquidation of company. Now, what is our travel in capital gains so far? We know what is a capital asset more by understanding what is not a capital asset. We know what is transfer, what is not a transfer. We know to a larger extent now when the numerator changes. Numerator is normally 317, but in some cases, it may not be 317. It will be some other value. What are all the cases? Extinguishment of asset, compulsory acquisition, conversion of asset into stock in trade, and specified agreement. In these four cases, the transfer might happen first and the taxation might happen in a different year. The transfer might have happened already, but the taxation, computation of capital gains will be happening in a different year. So, even though I am computing the capital gains in the financial year 21-22, maybe the numerator is not 317. The next case which we saw, in denominator, when will denominator change? Denominator might change whenever we consider the cost of acquisition of the previous owner. Whenever we consider the cost of acquisition of the previous owner or previous instrument, debentures converted into shares and sold, divided by year of conversion. Preference shares converted and sold, divided by year, or previous owner, all successions, gift, inheritance, all these cases, previous owner. The other cases, if the asset is purchased before 1/4/2001. So, this is the basic thing we understood yesterday. When does the numerator change? When does the denominator change? How it will have an impact in my computation. Then we walked forward and started with other cases. So, we started with liquidation. Okay, how the shareholder gets taxed. Today, we are starting with shares. After section 46, okay, section 46A talks about buyback of shares. Section 46A talks about buyback of shares. Buyback is not taxable in the hands of the shareholder now, majority of the time. Buyback is only taxable in the hands of the company. So, in assessment of company, section 115QA, we will look into section 115QA. Majority of the buybacks are taxable in the hands of the company. Okay. And it is only taxable in the hands of the company now, buyback. The shareholders are going to enjoy an exemption under section 1034. Okay, under 1034. But if it is not buyback of shares, it is buyback of other instrument, other securities. Though I call it as buyback, it is like a redemption, in which case it is taxable here in capital gains chapter. In which case it is taxable in the hands of the shareholder and not in the case of company. So, company is taxable for buyback of shares. The provisions we are going to discuss in 115QA when we do assessment of companies. Yeah, yeah. The question is, buyback means it is like surrendering shares and getting money. Is it not a transfer? Yes, it is a transfer. It is exempt under 1034. Okay, it is not that they are not recognizing it as an income. It is an income which is getting exempt under 1034A because it is going to be taxable in the hands of. There is no double taxation. Both the company and the shareholder are not paying. Only the company is paying tax for that. Is my video getting stuck? Is it okay now?
It's okay, sir.
Yeah.
Okay, sir.
Now, the next thing is speaking about taxation of equity shares. Taxation of equity shares, including listed shares specified under 112A. Taxation of equity shares is the next thing you have to understand. Before going into understanding the equity shares, listed shares part of it, I need to tell you a small preamble so that you can understand why this particular provision. I am talking about listed shares first. Till the financial year 1819, till the financial year 1819, listed shares, capital gain on listed shares is not taxable. Till the financial year 1819, capital gains on listed shares is not taxable. It is wholly exempt under section 1038. Till financial year 1819. Why? Because the companies were paying security, the shareholders are paying security transaction tax. So the entire capital gains is exempt under 1038. But then from financial year 1819, okay, till 1718 not taxable. From financial year 1819, it became taxable at a concessional rate. LTCG at a concessional rate. The budget for the financial year will be on 1st of February. Okay, understand this case because you need to know the backstory to understand, go forward and understand. The budget is presented in the parliament on 1st February. So on 1st February 2018, the finance minister said that from the financial year 1819, which is starting from 1/4/2018, I am withdrawing section 10 subsection 38. I am withdrawing section 10 subsection 38 and it is going to become taxable. At a concessional rate of 10%. We'll come to that. This is then on 1/2/2018 and it is the taxation arises from 1/4/2018. If you make a scheme like this, the next 2 months will be erratic in transaction. People will increase the cost of acquisition in such a manner that later they only get loss on something like that. So the finance minister said, for all shares, listed shares purchased till yesterday, 31/1/2018, cost of acquisition will be fair market value prevailing on 31/1/18. There is a way of computation, I'll tell you, but it cannot exceed FMV as on 31/1/2018. So that the next 2 months transactions are not going in an erratic manner, okay, and the entire capital gains get or the intention of the ministry gets distorted. That is why There is a significance for the date 31/1/2018. Not for any other purpose. Budget is read on 1/2/2018. If I bring a scheme from 1/4/2018, I know how erratic the next 2 months will be. To avoid that, the finance ministry said 31/1/18 value we will take. Okay, keep this in mind while doing the listed shares. This is the story of why shares gets importance. Okay, right? I also request you to download and keep. Because once the admin comes, I'll take that. Right. The provisions for listed as well as unlisted shares. Primary issue, that is, which is issued by the company. The price paid, including premium, if any. The price paid, including premium, if any. Bonus shares. Cost of bonus shares is nil. Cost of acquisition of bonus shares is nil. We are all clear, right? One of the provisions of section 49, which we studied, any asset acquired on or before 1/4/2001, actual cost or fair market value as on 1/4/2001, whichever is higher, can be taken as cost of acquisition. Interpretation of law. Bonus shares issued before 1/4/2001, cost of acquisition, because law says COA of bonus shares is nil, cost of bonus shares is nil. Okay, assessee friendly interpretation, beneficial construction. So for bonus shares allotted before 1/4/2001, I can take the fair market value as on 1/4/2001. Even if it is 1 rupee, it is higher. Okay. For bonus shares allotted after 1/4/2001, COA is nil. Beneficial construction. Shares purchased from other than company, purchase price paid plus any expenses at the time of acquisition. ESOP. Okay. Employee stock option. Fair market value on the date of exercising the option. Fair market value on the date of exercising the option, the day in which you are saying that I will go for this option. Fair market value on the date of exercising the option. Debentures converted into shares, we all know cost of debentures. Okay, right? Just for your understanding. For listed shares acquired, okay, before 31 before 31/1/18. For listed shares acquired before 31/1/18, two steps of computation. Two steps of computation. I told you what is the significance of the date of 31/1/2018. Okay. Step 1. Full value of consideration of shares or fair market value as on 31/1/2018, whichever is less. Whichever is less. Okay. So technically it cannot exceed FMB as on 31/1/2018. That's why whichever is less. 2. Step 1 or actual cost, whichever is higher. So in step 1, if I get fair market value as on 31/1/2018, which is higher than actual cost, I can take that. I can take that. So please understand, this is explained in section 112A. This is said in section 112A. For listed shares, okay, fair market step 1, I will compare full value of consideration versus fair market value as on 31/1/2018, whichever is less. That answer I'll compare with actual cost and determine whichever is higher. That will become my cost of acquisition. That will, if it is acquired from 1 to 2018, actual acquisition value, there is no change. For any shares, because I had a promise given to the shareholders that I will not tax them, I am withdrawing my promise. So I am giving this benefit. Take the fair market value as on 31/1/18. Okay, okay, right. Section 112A further says, section 112A, my dear friends, further tells us, okay, this is for listed shares, okay, only for LTCG this computation, only for LTCG this computation, okay. So section 112A further says, okay, no benefit of indexation. I will not give you any benefit of indexation. First rupees 1 lakh is exempt. Okay, if the total LTCG does not exceed 1 lakh, no taxation, it is exempt. Okay, LTCG exceeding rupees 1 lakh is taxable at the rate of 10%. LTCG exceeding rupees 1 lakh is taxable at the rate of 10%, concessional rate of 10%. Rebate under section 87A cannot be claimed. Rebate under section 87A, which says up to 5 lakhs, you can claim, that cannot be claimed in this particular case. In this particular case, we have seen this in the first class itself. Am I clear to you? So, looking at it, for listed shares acquired on or before 31, on which STT is paid, compare sale value, that is full value of consideration, and fair market value, determine whichever is less. Step 2, answer of step 1 with the actual cost of acquisition, determine whichever is higher. For listed shares purchased after 31/1/2018, actual purchase price will be considered. Am I clear to you? Okay, so these are the additional points which we have already seen. No benefit of indexation. First 1 lakh is exempt. LTCG exceeding 1 lakh is taxable at 10%, and rebate under 87A cannot be claimed. Only for listed shares, that too LTCG. STCG is 111A, taxable at 15%. Okay, unlisted shares in the normal methodology of computation. Don't worry, I'll sustain in the screen the questions so that you can just read through. Once that will come, I'll give it to you. The first rates of taxes, you have all this. Question number 17. Usha purchases 1000 equity shares in X Limited, an unlisted company. So the regular working, okay, at a cost of 30, paying a brokerage of 1% in January. She gets 100 bonus shares in August 2000. She again gets 1100 bonus shares by virtue of her holding in Feb 2007. The fair market value of these shares as on 1/4/2001 is rupees 80. On 1st Jan 2022, she transfers all the shares for 200 per share, brokerage at that time 2%. Compute capital gains taxable in the hands of Usha. Read through. Originally purchased is 1000 equity shares. Bonus issue before 1/4/2001 is 100. So for these two things, I can adopt the fair market value as on 1/4/2001 for these two things. Okay. Bonus allotted in 2006-7, 1100 shares. The value will be nil. Okay. So total number of shares are 2200. Total number of shares is 2200. Full value of consideration 2200 into 200. Yes. Cost of transfer. What is the brokerage at the time? 2%. 11,100 into 80 into 317 by 100. Okay. 1100 into 80 into 317, that is year of sales, by base year 100. Gross LTCG 'Tell me. You're stuck, friend. Yeah. ஸ்ரீராம் ஆன்லைன்ல தான் இருக்கான்னு நினைக்கிறேன்.
இங்கதான் இருக்கேன்.
ஆன்லைன்ல தான் இருக்கானா?
இதுக்கு மேல ஆன்லைன் கிடையாது, இனிமே ஒன்லி ஆஃப்லைன்.
ஆ?
இன்னையோட ஆன்லைன் ஓவர் சார், இனிமே ஒன்லி ஆஃப்லைன்.
Arun Jaitley, finance minister, when he took over, he said, "No more I will make any retrospective amendment."
But I will try to keep it up, sir.
Yeah, legacy. சார்ட்ட கொண்டனால எல்லாத்துலயும் போய் சொல்லணும்னு ஆயிடுச்சு. Fully qualified போல இருக்கு நீ. Shall I? Yeah. Right. Question number 18, complete capital. Patiently compute capital gains. We know the two steps to compute the cost. Compare full value of consideration or FMB as on 31/1/2018, whichever is less, that with actual cost. When I look into the question now, 200 or 250, whichever is less, 200, okay, that with actual cost. That which actual cost, so my cost become whichever is higher, so my cost becomes 200, so 50 rupees is the gain. The sale value is 250, 50 rupees is the gain into the number of shares, 1000 shares, so I am getting 50,000. I am getting 50,000, right? In the second case, my sale value is 150, my cost 200 or 150, whichever is less, that answer with 100, whichever is high, so I get 150. I get 150, so my CG becomes nil, my capital gains becomes nil there. Third case, 50 is my sale value, 50 or 150, whichever is less, that answer with actual cost, so 100 becomes higher, okay. Sorry, 150 becomes the sale value, so 40,000, that is 50 into 800 shares, 40,000 becomes the capital gain. Last case, 50 is my sale value, 200 or 50, 50 into 100, so 100 becomes higher, so I'm getting a total LTCG of 35,000. As our friend said, this is wholly exempt under 112A. I just computed up to 1 lakh, it is not taxable. Am I clear? Am I clear to you? Shall we move on? Okay. Question number 19. Yamuna had purchased 2,500 shares in April 2014 for rupees 46 per share, and she paid STT. She sold these shares in December 21 for 310 per share through a recognized stock exchange, paying STT. Compute capital gains in each of the cases. If the fair market value is 110, if the fair market value as on 31/1/2018 is 40, shares are quoted on 31st March to Jan 2018 at 110, 115, 118, 107. Highest should be taken. Highest should be taken. So I will consider 118. Highest should be taken. Had Yamuna purchased these shares in 2014 for 330 per share, what would be the capital gain? Taking case A itself, you can say that answer. E. Compute the tax payable by Yamuna in case A, assuming she don't have any other income and capital gains is the only source of income. F. In May 2020, she was allotted 2 shares for every 1 share. The fair market value as on 31st January is rupees 110 per share. Again, a similar question only, giving it to you in the paragraph format, not as a tabular format, but as a paragraph format. I will answer question E later. That is, the extension of A is only E, don't worry. First do A, B, C, D, F. First do A, B, C, D, F, please. These are all the answers which we are getting. If I am getting 887 500 Banapriya, the answer is there on the screen. In this case, 110 is the cost we are getting. In this case, 46 is the cost we are getting. In third case, 118. So we should take whichever is higher. In fourth case, case B, 330 because the actual cost becomes higher. And in fifth case, total number of shares is 3,750. 2,500 regular shares plus 1,250 bonus shares. So 3,750 shares into 310 minus the cost of acquisition only for 2,500 shares because bonus is issued after the date. So I'm getting a gain of 887,500. Once you are over with it, I will continue for case E. computation of tax in case A. That is what is our case E is about. Okay, that is what is the case E about. LTCG under section 112A is 5 lakhs. LTCG under section 112A is 5 lakhs. Yes, exemption up to 1 lakh, nothing is taxable. Okay, okay, taxable LTCG, taxable LTCG is 4 lakhs. 4 lakhs. I want you to understand something. Compute the tax payable of Yamuna in case A, assuming she don't have any other income. Any other income. So the basic exemption benefit should be given. The basic exemption benefit should be provided. Okay, because she don't have any other income, basic exemption limit of 2,50,000 can be adjusted. That cannot be adjusted only against lottery income or winnings. Winnings are fully taxable. Okay, whereas these things, STCG on which STT is paid, LTCG on which STT is paid, and general LTCG, in all these cases, if there is a shortfall in the basic exemption limit, that can be set off here. We will do it in assessment of individuals. So basic exemption limit is 2,50,000. So now I am getting 1,50,000. Okay, tax, base tax at the rate of 10%. 1,50,000 into 10%, 15,000. Okay, for your benefit, I am writing and keeping it here. Note, rebate under 87A cannot be claimed. Okay, so add HEC at the rate of 4%, and HEC at the rate of 4%. Okay, so total tax payable comes to 15,600. It's very law itself is clear. 87A you cannot claim rebate. 1038. Marginal relief for what? Oh, okay. Marginal relief is a concept only for surcharge, not for base tax. Yeah, yeah, I understand your question. Had I taxed it at 5%, it would have been less. That's what you are saying. But these are special rates of taxation, which is part of income tax law, not Finance Act. Are you clear? Right? Okay. in the next arena of our understanding, we are crossing 49 and walking into section 50. Okay, so for 45, basis of charge and various types of computation. 46, liquidation. 46A is with regard to buyback of shares. 47, transactions not considered as transfer. Okay, the 10 list which we saw depending upon the nature. 48, mode of computation. 49, cost of acquisition in various cases. We are moving now out of 49 and walking into section 50. 50, capital gains on depreciable assets. When will depreciable asset will have capital gains? Only when the block ceases to exist. Block ceases to exist in two circumstances: when all the assets in the block are sold, or when the sale value exceeds the balance available. The resulting gain or loss is short term. Okay, this is the law in 50. Though we have worked out earlier itself these things, but this is coming under section 50. Okay, this is coming under, we worked out in insurance compensation, even in PGBP, the first question, all the books are sold, we had a loss, all those things will fall under section 50. Okay, in case of depreciable asset, how to compute. Am I clear to you? Right? Sinhania and Co., a sole proprietorship firm, owns 6 machines put into use in the business in March 21. The depreciation on these machines are charged at 15%. The written down value as on 1st April is 8,50,000. 3 of the old machines were sold for 11 lakh, and a second hand machinery, because the purpose is understanding block existence, so no additional depreciation. That's why second hand machinery was purchased for 850 on 30th November. A, determine the claim for depreciation, compute the capital gain. Third case, if Sinhania and Co. has sold all the 3 machines for 21 lakhs, will there be any difference in our working? Read through. Hmm? sorry. This is 850. In the third case alone, the sale value is 21 lakhs. In the third case, that is in this case, I'm taking 21 lakhs. This I can even name it so that for your ease of understanding, I can call this as case A and B and this as case C so that you are very clear. In this case, there is still balance available for depreciation. Okay. So in case A, where the sale value is only 11 lakh, claim of depreciation will only be there, capital gains will not be there. Capital gains will arise only if the block ceases to exist. Here the block is still there, so capital gain will not be there. Balance available for depreciation, less depreciation. Okay, we all know it is 6 lakhs at 7.5% because it is less than 180 days. Okay, at 7.5%. Closing WDB is, so in this case there will not be any capital gain, okay, since the block is there. Whereas in the second case, okay, short term capital gain, the block ceases to exist, so short term capital gain will be 4 lakhs. Short term capital gain will be 4 lakhs. Is it clear? Short term capital gain 4 lakhs. Am I clear to you? So this is how, why in case B it is not there means block is existing. Okay, right? So simple question only. We have done the material question. Okay, all right. The next section is section 50C, immovable property transfer. Immovable property transfer, transfer of immovable property. Okay, land and building. Okay, in the case of land and building, full value of consideration will be actual sale value or stamp value prevailing on the date of transfer, whichever is higher. Deeming provision. In income tax law, we call it as deeming provision. Okay, actual sale value or stamp value prevailing on the date, whichever is higher. However, where the stamp value does not exceed 110% of sale consideration, okay, 10% tolerance limit, okay, we call this as tolerance to the extent of 10%. Okay, stamp value is not exceeding 110% means take actual consideration itself. Okay, however, where the stamp value does not exceed 110%, then sale consideration, that is actual consideration, will be full value of consideration. Assessee has the right to dispute the stamp value. The assessee can say the stamp value which you have determined is wrong. Okay, how it can be wrong? For your understanding, for your practical understanding, I'll tell you. A property, a land in Alvarpet, you can imagine the stamp value, right? You can imagine how expensive it is, the one of the heart of the city. Okay, so crores. Okay, crores, you are right. So stamp value of Alvarpet, I'm giving you just a practical example. Stamp value of Alvarpet, let's take 5 crores. In Alvarpet, there is a particular area called De Monte Colony. In Alvarpet, there is a particular area called De Monte Colony, okay, which is considered as a haunted area. அது தெரியாது எனக்கு உண்மையா, நான் இல்ல. Okay, but it is considered so. Yeah, I accept with you. I'm just telling you, can that now the assessee can say, boss, I accept Alvarpet's value is 5 crore, but I am purchasing a land which is not considered as lucky, which is not considered as better. So you cannot apply the same stamp value over there. Leave that example. Normally, a land is 2,400 square feet, one area, one ground, one area of land. 2,400 square feet. If it is a square, then the rate is very high. On the other hand, if it is 240 into 10, which means narrow but straight, can I apply the same rate here? So I'll ask the valuation officer, boss, you're right, 5 crores is the value, but look at this land. This land is not in the same dimension, or okay, we are a country of sentiments. We are people, all of us, we can definitely tell we are all people of sentiments. Okay, so there is something known as Terukuttu land, the landing area, okay, which will not have the same value, but a corner plot will have a higher value than any other plot because you cover a 2-road dimension. So like this, various aspects. So the assessee has the right of disputing the stamp value, and once assessee asks for, assessing officer don't have an option, appoint a valuation officer. Assessee has asked, I'm not happy with the stamp value, appoint a valuation officer. Okay, where the valuation officer determines a lesser value, then that becomes stamp value. Where a valuation officer, okay, gives a lesser value, then that becomes stamp value. Please remember, valuation officer cannot increase the value. Valuation officer cannot increase the value. Okay. Where the immovable property transferred is stock in trade, same provision, but it is taxable under PGBP 43CA. Okay, 43CA is the provision. Okay, stamp value on what date should I take? Okay, is it date of agreement or date of registration? Where advance is received through approved modes on the date of agreement. Where no advance is received or advance is received by unapproved modes. Unapproved modes are where cash bearer check, cross check, date of registration, on the date of registration. Okay, right? I request you to read through once. Raja, தப்பா புரிஞ்சுக்கிற. Increase பண்ணா you are at a loss. I want him to reduce. Okay, so valuation officer reference is very popular. Government fixed. I told you the reasons now. No, government fixes on the basis, not basis of what is the dimension of the land, where the land is. 2,400 square feet in Nungambakam or Alorpet, 5 crores. So I sell a 2,400 square feet to Shaji. For Shaji is purchasing it for 4 crores. Shaji contest why it is not 5 crore in my case. Because of the following reason. You appoint a valuation officer and see, my land will not fall under what the government has regulated as 5 crore. My land has certain non-benefits. That's why. So sub-register office will not apply. State government will not test. This is income tax. That is valuation tax. They will not accept a lesser value at all. They will say pay stamp duty for 5 crores. Read through. Our friend Banupriya says that the video is lagging for her, and is it the same for others? Is her question.
Sir, it's been lagging, but I was sir.
It happened twice.
Once more.
It happened twice, sir.
It happened twice.
Okay. Some of the important questions, some of the important provisions now. Okay. I'm there in question number 21. I'm there in question number 21. Rajiv owns a land in Bangalore. The date of acquisition is in 11/12 and the value of acquisition 4,76,000. In March 22, the land was sold by him for 46 lakh. Compute capital gain in each of the cases. Value adopted by stamp authority is 55, 48. Value adopted by stamp authority is 55. Rajiv files an appeal under Stamp Act and the court reduces the value to 50 lakhs. D. If Rajiv is a dealer in land and the said land is stock in trade. Okay. The agreement for sale was entered on 10th April 21. It should be not 2001. It should be 10th April 2021. Not 2001, when the stamp value was 49,50,000 and registered in March 22 for 53 lakhs. Read through the question. First three cases I'm working out. Full value of consideration. Full value of consideration. How to compute? Actual consideration. In first case, actual consideration is 46 lakhs. Stamp value is 55 lakhs. 110% of actual consideration. 110% of actual consideration is 50 lakh 60,000. Since stamp value exceeds 110% of actual consideration, okay, stamp value should be taken as full value of consideration. Since stamp value exceeds 110%, I will take 55 lakhs in case A. In case A. In case B, 46 lakhs, 48 lakhs, 110% is 50 lakhs 60,000. Since stamp value does not exceed 110% of actual consideration, actual consideration will be treated as full value of consideration. 10% is the tolerance limit. So, if it is not exceeding the tolerance limit, then fine. You can take the actual consideration itself as, okay, 10% acceptable variation. Am I clear? Okay. In third case, again 46 lakhs. Okay. Value, the Rajiv files an appeal and the court reduces the value. Court means that is the valuation officer. Okay. That is value determined by VO. Okay. Is 50 lakhs. Again, that will become the stamp value. that will become the stamp value. Again, the same rule will be applicable, and the full value of consideration will only be 46 lakhs, because the value determined by the stamp authority will become value determined by the valuation officer will become stamp value, and it has not exceeded 110% of actual consideration. So it will again be 46 lakhs. Am I clear to you? Any doubts? Shall I move on? Okay, right. If Rajiv is a dealer in land and the said land is in trade, that is stock in trade, the agreement was entered on 10th April 21. The stamp value 4950, registered in March 22 when the stamp value is 53 lakhs. Okay. When the land is stock in trade, section 43CA is applicable because it goes to the previous chapter. Business or stock in trade is not a capital asset, so it goes to business or profession. Particulars. Okay. Advance received through approved modes. Advance not received slash received through unapproved modes. Okay, two ways we are going to answer, where the advance is received through approved modes, or either advance is not received or it is through unapproved modes. Full value of consideration, actual consideration is actual consideration is 46 lakhs. Stamp value on the date of agreement. When will you take stamp value on the date of agreement? If advance is received through approved modes, I will take stamp value on the date of agreement, which is 49 lakh 50,000. Okay, stamp value on the date of registration Stamp value on the date of registration 53 lakhs. Stamp value on the date of registration 53 lakhs. 110% of actual consideration. 110% of actual consideration, okay, is 50 lakh 60,000. Is 50 lakh 60,000. So, if advance is received through approved modes, I will take the sale consideration as 46 lakhs. If advance is received through unapproved modes, I will take the sale consideration as 53 lakhs because in case A, it is not exceeding 110%, whereas in case B, it is exceeding 110%. So, sale consideration, here it will be 46 lakhs, whereas here it will be 53 lakhs. The difference is because it exceeds 110%, in the other case it does not exceed. Less cost of land. Okay, cost of land 4 lakh 76,000. 4 lakh 76,000. So you will get a gross profit. I'm not taking the business expenditure, only gross profit. Yeah. Am I clear? Okay. So advance received through approved modes, unapproved modes. Fifty CA is full value of consideration of unlisted shares. We all know unlisted shares or unquoted shares. So a private limited company should not transfer shares at a lesser value. So they say actual consideration or fair market value of the share, okay, which will be computed using the net worth method, okay, whichever is less. Whichever is less. Of course, if the company is in NCLT, this provision does not work, or the directors are suspended, this provision will not work, but that is rare. Okay, 50D fair market value when I will consider it as full value of consideration, where you are unable to, the consideration is indeterminate or unknown, it will be fair market value. One best example is exchange. I give an asset and get an asset. What I transferred is also a capital asset. What I receive is also a capital asset. For the transferred asset, what is the full value of consideration? FMV of the incoming asset. FMV of the incoming asset will be regarded, okay, as the full value of consideration. Okay. So section 50, I need to come to 50B. Otherwise, 50 is depreciable asset. 50C is immovable property. 50CA is unlisted shares. Okay. 50D is where exchange of others, wherever they are unable to determine. Section 51 is not there in the law as of now. Okay, this has been removed, but there is a provision which we need to understand. Advance money received and forfeited. For a minute, please listen the story so that you are clear. To tax an income under this chapter, the two conditions are: it should be a capital asset, it should have been transferred. So example I'm giving you is, suppose a circumstance where I have a capital asset. I enter into an agreement to sell the capital asset and I receive advance of, let us take 5 lakhs. Within 6 months, the balance money has to be paid. Otherwise, the advance will be forfeited because I'm losing the opportunity of selling it to others. So the advance will be forfeited. The proposed buyer did not pay me within 6 months. So advance money was forfeited. Capital gains does not arise. Because to tax, it should have been transferred. Transfer was not there. So this advance money forfeited is not taxable under capital gains. And initially, it was not at all getting taxed anywhere. Act was changed in 2014. That's why I say now it is not there. To say, now the law says advance money forfeited is taxable as income from other sources. That is, on or after 1/4/2014, on or after 1/4/2014, if I have received any advance money and that has been forfeited, don't worry, it would have been taxable under IFOS from the financial year 14-15. But what happens before that? If I have received the advance money in 2007-8, 10-11, what happens? Advance money received and forfeited before 1/4/2001 has to be reduced from cost of acquisition. Advance money received before 1/4/2014 has to be reduced from cost of acquisition. Advanced money received and forfeited by the assessee. Friends, I have a reason to tell this. Advance money received and forfeited by the assessee. If advance money is received and forfeited by the previous owner, you need not reduce it. Okay? The most important aspect to understand is that in the case advance money is received and forfeited by the previous owner, adjustment need not be made. Because the law reads advance money received and forfeited by the assessee should only be adjusted. Okay, okay, right? By the previous owner, you need not make any adjustment. Okay. So advance money forfeited. If the question says it is before 2014 and by the same assessee adjusted with the cost of acquisition and then index it. Otherwise, no. Hmm? Advance money forfeited by the same assessee if it is before 31/3 on or before 31/3 2014, adjusted with the cost of acquisition and then index it. Question number 22. Mr. K purchases a house property in 92 for 65,000, fair market value 270, whereas the stamp value is only 250. In August 2005, K entered into an agreement with J for sale of such property for 3,70,000 and received 60,000 as advance. However, as Mr. J did not pay the balance, Mr. K forfeited the advance. In 2009 May, Mr. K constructed the first floor at a cost of 235. Subsequently, in 2010, K gifted the house to his friend D. On 10th Feb 22, D sold this house for 12 lakhs. Compute the CG in the hands of Mr. D. The advance money need not be adjusted. Advance money need not be adjusted because it is by the, yeah, that's beautiful. That's why I waited. And we have to give two answers. Whenever the concept of previous owner comes, we need to provide two answers, one as per law, as per Manjula. So let's go ahead. Question number 22. Let's start with the note. Advance money received and forfeited by the previous owner need not be adjusted against COA. I can only take 2,50,000 because stamp value, because fair market value exceeds stamp value. I can only take 2,50,000. 2,50,000 stamp value as it is less than FMV into 317 divided by, as per law, okay, in Jan 2010. So 910. As per law, it is 910 148. as per Manjula J. Shaw. May 2009, that is also 910. Shall I? Question number 23. Mr. X purchases a house property in December 93 for 525 and an amount of 175 was spent for improvement. The said property was proposed to be sold by him and advance of 40,000 was taken. As the entire money was not paid in time, X forfeited and subsequently sold the property in March 22 for 52 lakhs. The fair market value 11 lakh 90,000. In this 11 lakh 90,000, I should adjust that 40,000 and then only index it. Whatever I take it as cost of acquisition, I should reduce the advance money received and forfeited on or before 1st April 2014 and then compute. Go ahead. A friend was asking me a question about cost of improvement. Cost of improvement before 1/4/2001 should be ignored. It should not be considered at all because FMB, whatever we are saying is on 1/4/2001 includes that cost of improvement which we have made. Am I clear? Okay. The next arena to focus upon is business restructuring. Business restructuring. Restructuring means reconstitution of the business, which are amalgamation, demerger, conversion, and slump sales. As far as amalgamation is concerned, there is nothing in capital gain to understand that, because we know it is exempt. The whole transaction is exempt, both for the shareholder as well as the company. The whole transaction is exempt. Only amalgamation gets importance in set of chapter. Section 72A tells us whether the loss of the amalgamating company can be carried forward by the amalgamated company. That is in set of chapter, we'll deal with it separately. But as far as capital gains is concerned, there is nothing. Okay. Amalgamation means all assets and liabilities should become the assets and liabilities of the transferee company. 75% of the shareholders of the transferor company should become, I think, accounting 90% on the merger, but here 75%. Capital gain provision. If the transferee company is also an Indian company, then transfer of assets in the scheme of amalgamation will not be considered as transfer. No capital gain. Section 47. Shares allotted in a scheme of amalgamation by the transferee company to the shareholders of transferor company is also not regarded as transfer. No capital gain arises. For the shareholders, cost of acquisition of shares of transferee company is the cost paid for acquiring transferor company shares. Okay. Capital gain does not get attracted in amalgamation. It is more to do with set off. Let us look into it later. But the second and the most interesting is demerger. What is demerger? A time to talk about demerger and its taxation in full. What is demerger? One company splitting it into two. One company splitting into two. I am transferring, because I want to focus more, I am transferring a unit or division into another company. In law, that one company which is going to split is known as demerging company, and the result of demerger is one other company, so that company is called resultant company. Repeating, transferor entity is known as demerging company, transferee entity is known as resultant company. So I am transferring a part of the undertaking or unit to a different company. Demerging, not a transfer, provided conditions are satisfied. What conditions? All the assets and liabilities of the demerging company, of the unit, identified unit of the demerging company, should become the assets and liabilities of the resultant company. Common assets. I have the option. Office building is there. All the units share the same administrative office. So, factory building for the demerging unit. I don't have an option. I need to transfer to the resulting company. Office building, I have the option. Liabilities, all identified liabilities should be transferred. All identified liabilities should be transferred. Common liability, inga option kadayadu. Then what you will do is you will transfer asset alone. Should be transferred in proportion to the asset. Okay, let's understand. Means the transfer pursuant to 230 to 232 of Companies Act 2013. Sorry, I have changed the section number, but here I didn't say. Okay, it is 2013 only. but the section numbers are correct. Previously, it was 392 to 395 of 1956. Now it is to by a demerged company by one or more of its undertaking to any resultant company. All the assets identifiable to that asset unit which is demerging shall be transferred. In case of other assets, the demerged company has an option either to transfer or not. All liabilities of the demerging unit shall be transferred. Other liabilities should be transferred in proportion to the assets taken over. Okay. Similarly, business loss. The loss of the demerged company should also be transferred in proportion to assets taken over. Assets and liabilities to be transferred only at book value. We all know that 75% of the shareholders of demerged company should become the shareholders of resultant company. Asset that cannot be transferred or any what I would call fictitious asset. Unamortized amount, miscellaneous expenditure not written off, etc. Okay, this is demerger. This is demerger. If you follow these conditions, no capital gain arises. If you follow all these conditions, no capital gain arises both for the company and for the shareholder. Okay? Now, understand the case where I am the shareholder of demerging company, transferor company. The resultant company allots me shares for demerger. இப்போ இதோட cost of acquisition எனக்கு என்ன? When I am subsequently selling it, what is the cost of acquisition of shares of my resultant company? The law says same like assets. There is a formula for computing. For the shareholders of demerging company who is allotted shares in resulting company, cost of acquisition is A into B by C. Cost of acquisition of shares of transferor company into asset transfer divided by total value of asset. Okay, I'll explain you when we do a question. Now, just read the theory once. Huh? As on the date of transfer. Adhe proportion, exactly, the same proportion. I'll explain you now. Yes, sir. You're right. You're right. Okay, that's the last point I have written. Cost of balance shares of demerging company will be actual cost of acquisition minus cost of shares allocated to demerger. Read through. right? I mean, question number 27, 24. I mean, question number 24. The balance sheet of X Limited, equity reserve, securities premium, general reserve, revaluation reserve of land 1, land of unit 1, building of unit 2, loan taken for purchase of plant and machinery of unit 1, general loan, current liabilities unit 1, unit 2, bank overdraft. Assets of unit 1, which includes deferred revenue expenditure, which is not an asset, recognized asset. Unit 2, general land and building, investment, cash and bank, miscellaneous expenditure is not an asset. Accumulated losses 45 lakhs. Unit 1 is demerged. Specify the tax impact to fulfill 219AA, assuming 50% of other assets is taken over by the resultant company. Read through, we'll do. A question to understand 219AA. More than tax, a question to understand the definition of to demerger. The law says all identifiable assets should be transferred. Okay, identifiable assets of unit 1. Identifiable assets of unit 1. What are all they? What are all they? Land. How much is the value? 30 lakhs, which is wrong. Always revaluation should be ignored under income tax law. Yeah, revaluation is never a concept. Land ignoring revaluation. Okay, ignoring revaluation is 26 lakhs. 30 lakhs is the original value. 4 lakhs is the revaluation amount. So the land is 26 lakhs. 26 lakhs. Plant and machinery 75 lakhs. Stock and debtors 10 lakhs. Deferred revenue is not an asset. Common asset. It says 50% is transferred to the resulting company. The question says among the common assets, 50% is transferred to a resulting company. Common assets are general land and building, 15 lakhs. investments, 5 lakhs, cash and bank, 5 lakhs. Miscellaneous expenditure is never an asset. Identifiable liabilities. Loan for unit 1. Loan for unit 1 is 40 lakhs. Current liabilities of unit 1. Current liabilities of unit 1 is 7 lakhs. Less common liabilities in proportion to asset transfer. Common liabilities are two things. Okay. General loan 3 lakhs. Bank OD 10 lakhs. So common liabilities is 13 lakhs, my dear friends. Okay. Common liabilities is this. Asset transferred, we all know, is 1 crore 36 lakhs. Asset transferred, we all know, is 1 crore 36 lakhs. Total assets, please understand. In proportion to asset. Our friend's question, which I want to clarify, can't I just take 50% of common liability also? No. See, this general loan of 3 crores might even be for this plant and machinery, even be for this stock and data. It can be for any asset, not for common asset. If it is a common liability for common asset, I can take 50%. But this can be for anything. So in proportion to asset transfer. Okay. So now common liability is 13 lakhs. Asset transferred, we all know, is 1 crore 36 lakh. Total assets. Please understand. Okay. It is 230 minus 2 minus in the deferred revenue expenditure, another 2 minus revaluation of 10. Repeating, 230 total, okay, balance sheet total, okay, and this 2 is miscellaneous expenses. This too is deferred expenses, and this 10 is revaluation. Revaluation is never a concept, so that also should be taken out. So repeating, 2 crore 30 lakhs minus 14 lakhs, 2 plus 2 plus 4, 14 lakhs. Okay, 2 crore 16 lakhs is the total asset. Now, common liability in proportion to assets transferred will be 13 lakhs into 1 crore 36 lakhs divided by 2 crore 16 lakhs. Patiently write it out. This will be the share capital of the resultant company, and 75% should be held by the transferors of, okay. There, because no monetary consideration can be paid, this will be the share capital of the resultant company. Loss to be transferred, okay. Total loss of demerging company is, I think, 45 lakhs. That's what the question says. 45 lakhs. Assets transferred 1 crore 36 lakhs. Total assets 2 crore 16 lakhs. So loss apportioned to resultant company, okay, same formula, 45 lakhs into 136 divided by 216. This can be carried forward by the resultant company and set off over the balance period. So totally 8 years means already 5 years over now, balance 3 years only. ம்? இல்ல இது இது உங்களுக்கு அண்டர்ஸ்டாண்ட் பண்ணிக்கிறதுக்கு தான் இந்த கொஸ்டின். This is just to make you understand how this 219 AA works. I'll go to the next question, which is an exam question, which you will see much simpler. What is difficult here? Seems new. Yeah, exactly.
Sir, what does the balance period mean?
So business loss can be carried forward and set off over 8 years. Already 5 years is over, means the balance 3 years, this 28,33,333 has to be set off over the balance 3 years.
Got it. Thank you, sir.
This is an examination question, but it came for 16 marks. SS Private Limited, a domestic company having two undertakings engaged in the manufacture of cement and steel, decided to hive off cement division to RV Private Limited, a domestic Indian company, by way of demerger. The net book value of the assets before demerger was 80 crores. The net book value of asset transfer 20 crores. You need not compute anything, etc. The demerger was in Jan 22. In the scheme of demerger, it was fixed that for each equity share of rupees 10 each in SS Private Limited, 2 equity shares were to be issued by RV Private Limited. One Mr. NK held 50,000 equity shares in SS Private Limited, which were acquired for 8 lakhs in 1617. Mr. NK received 1 lakh equity shares of RV Private Limited in January 22. He sold these in March for 18 lakhs. In this background, you are asked the following. Does this transaction of demerger attract income tax liability? Yes. In what manner? Hey, திருப்பி சரிடா பாதியில் நிறுத்திட்டேன் நான் தான் கொஸ்டினை மன்னிச்சிடு. Does this transaction of demerger attracts income tax liability in the hands of SS Private Limited and RV Private Limited? Need to work out. What do you want to work out? Transfer of asset in a scheme of demerger. Is it regarded as transfer? ரொம்ப கான்ஃபிடென்ட்டா இருங்க. No. Amalgamation, demerger, no. It is not transfer. Transfer of asset in a scheme of amalgamation by one Indian company to another Indian company, not a. Similarly, transfer of asset in a scheme of demerger by one Indian company to another Indian resultant Indian company, no, it is not regarded as transfer. It is not regarded as transfer. Quick-ஆ போயிட்டு வந்துடலாமா அங்க இடத்துக்கு? Okay, ரொம்ப uncertain-ஆ இருக்கீங்க. But I assure you that we know this. Okay, demerger for company as well as shareholder. Transfer of capital asset in a scheme of demerger by demerging company to the resultant company is not a transfer. Shares allotted by the resulting company to the members of demerging company is not a transfer. Okay, so be confident about that. Okay, so this is not a transfer. Okay, no tax liability both for both the companies. State the condition in brief which has to be satisfied. All the assets and liabilities of the identifying unit should be transferred. Common asset adoption. All liabilities identified transferred. Common liability in proportion to asset. 75% of the shareholders of the demerging company should become the shareholders of resultant company. Compute the capital gain that could arise in the hands of Mr. NK on sale of shares of RV Limited. Third question. Compute the capital gain that would arise in the hands of NK on receipt of shares of RV Limited. Not taxable because it is not regarded as transfer. Fourth, we will do that computation. Compute the capital gain that could arise in the books or in the hands of NK when he sold the shares of RV Limited. 5. Will the sale of share of NK affect the tax benefit availed by SS Private Limited or RV Private Limited? No, it has nothing. Okay, the firm kadayadu. 51% should be continued. There is no such condition. If Mr. NK want to avail some tax exemption under the provision on the what are all the benefit, if so stated brief, we'll go to that. But do you understand this? Okay, this is a 16-mark question. I mean it. It's a 16-mark question. Okay, but you have to write the conditions. You have to write the condition. That is all assets, etc., etc., and state the obvious. Okay, according to section 47. Okay, transfer of asset in a scheme of demerger by the demerging company to the resultant Indian company is not regarded as transfer. In the instant case, since RP Private Limited is an Indian company, the transfer is not regarded, hence no capital gain arises. Like that, you have to brief it out. Okay, later in the Excel, I will write the answers, but as of now, I assume that the class knows all the theoretical answer, so that I'll go to part 4 onwards. Part 4 and part 6, I will work it out. Part 4 and part 6. Part 4. Compute the capital gain that could arise in the hands of Mr. NK on sale of shares of RV Limited. Let me do the working note for cost of acquisition of resultant company shares. Okay. COA of demerging company shares. What is the price at which I purchase the demerging company shares? What is the price at which I have purchased the demerging company shares? Mr. NK ஆரம்பிக்கிற paragraph படிங்க. 8 lakhs. Okay, 8 lakhs. Friends, okay, here is Mr. NK held 50,000 shares which were acquired in financial year 16-17 for 8 lakhs. Okay, 8 lakhs. Okay, COA of resultant company is, okay, for your, I am writing the formula, COA of demerging company into asset transferred divided by total asset in proportion to the asset taken over. Okay, what is asset transferred to the resultant company? In the first paragraph, you have it, 20 crores. Okay, total assets 80 crores. 80 crores. So COA will be 8 lakhs into 20 by 80, 2 lakhs. 8 lakhs into 20 by 80, COA of resultant company will be this. COA of demerging company, okay, will be 8 lakhs minus 2 lakhs. Original purchase minus whatever allocable is. Is this clear? Listed shares, na? Yes. 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 What is the capital gain now you are getting? He sold all the shares of RV Private Limited for 18 lakhs. How much is the capital gain? 8 lakhs into 20 by 80.
Ah,
15 lakh. Okay. You will be right as per law, as per Manjulajesha. If you have done like this, you are right. Why? Because as per law, the denominator will be Demerger happened only in 2022. As per Manjula Jesha, previous. It is a long-term capital asset because for computing the period, I will take the previous owners or the previous period also. Okay, somewhere we saw in the first itself that what is deemed holding period. Okay, deemed holding period. Shares allotted in a scheme of amalgamation or demerger, period of holding of the preceding company will also be included. So no doubt it is a long-term capital asset. No doubt it is a long-term capital asset. Okay. Full value of consideration. What is that sound? Okay. 2 lakhs into 317 divided by 317, year of demerger. Okay, year of demerger. In the case of law, it is 2 lakh into 317 by 317, whereas in the case of Manjula Jesha, into 317 divided by 2016-17. 2016-17, which is 264, which is 264. Am I clear to you? Okay, okay. The last part of the question asks us, okay, what benefit NK can claim? Case 6. Okay, section 54F is the only benefit, okay, NK can claim if he invests in purchase or construction of a house property. No other benefit can be claimed. No other benefit can be claimed. Anyhow, you'll understand those exemptions. Okay. 54 is sale house property, buy house property. 54B is agricultural land. 54EC is only for sale of land and building. This is sale of shares. So 54F is the only benefit available. If the conditions are fulfilled, which are mentioned in 54F, probably he can get that exemption.
Sir, could you once scroll up to the starting of this sum? This one. That's it. Thank you.
Yes. Okay. So this is how demerger. Okay. It's a very simple thing. Okay. Only more of theory. Okay. Right. The third type of reconstitution or reconstruction is what is going to be the question, be it in May or November, is slump sales, which has been entirely amended. Finance Act 2021 has amended the whole of slum sales. Okay, right from the definition of slum sales. Okay, right from the definition of slum sales to the whole of slum sales, they have amended. Okay, okay, to the whole of the impact. Okay, it has been amended. I will just give a theoretical aspect now. We will continue with the solutions tomorrow morning. Okay, what is slum sales? It all happened that a very famous company transferred their glass manufacturing division. Okay, the glass manufacturing division for 100 crores. What is the value of the land or factory building you transfer? That we don't know, sir. He said 100 crores couldn't and the division he paid me. Sale of part of a unit of an undertaking without assigning values for individual assets and liabilities. I don't know what is the value of factory building, plant and machinery, debtors, stock, goodwill, nothing I know. I said, my division I am transferring to you for 100 crores. What happens? The law uses, unfortunately, the word sale. So what happened in a recent case? I transferred my division and in turn I got another division of that company, which is exchange. I transferred division, got shares allotted, which is also exchange. Court said not taxable. நீங்க தான் sale யூஸ் பண்ணிருக்கீங்கன்னு. Now the new definition, transfer. What is transfer? Sale, exchange, extinguishment. Relinquishment, extinguishment. So the first thing they amended in the definition is transfer of a unit of a part of an undertaking without assigning values for individual assets and liabilities. The effect is, in the erstwhile provision, only monetary consideration became taxable. Consideration in the form of exchange were not taxable, but by substituting the term with transfer, that is sealed. Yeah. Huh? Sale without consideration, I don't want to tax the transfer. Okay. Sale without consideration, not a gift. Yeah. That's not tax. Okay. Now comes the next question. What is this full value of consideration? Okay. So there, the problem was like this. Only monetary consideration were taken in the erstwhile provision before amendment. After amendment, uh, the law said we will notify. What is the advantage? I gave it to a subordinate legislation. Now I don't want Parliament to come and say. So a subordinate CBDT said in May 21 they issued the circular. In May 21, they issued the circular. This is going to be the question for the next year itself, saying full value of consideration is either the monetary consideration or fair market value of asset you have transferred, whichever is higher. Either the monetary consideration you receive or consideration you receive or fair market value of the asset which you are transferring, whichever is higher. By this, what we are doing is, we are going out of the definition itself. Because definition of sum place sales without assigning values of individual assets and liabilities, you assign value. Okay, which is the biggest problem now. Okay, so what is full value of consideration? The law says, the notification says FMV1 or FMV2, whichever is higher. Okay, slow. Pre-amendment, monetary consideration for transfer of unit. Post-amendment, either monetary consideration, in fact, monetary could have either consideration or FMV of the asset transfer, whichever is higher. Unfortunately, in this process, the definition of not assigning value is overlooked. Okay, அது எனக்கு தெரிஞ்சது நான் எழுதிட்டேன். Okay, CBDT issued a circular on 24th May 21 by incorporating a new rule called Rule 11 UAE, which specifies the mode of computation of FMV. Full value of consideration is FMV1 or FMV2, whichever is higher. Broader understanding, FMV1 is taking into account deemed value, FMV2 is taking into account monetary values. Okay, otherwise, easier understanding, FMV1 is about transfer of asset, FMV2 what I get as consideration. Either asset transferred or whatever I receive as consideration will be full value, whichever is higher. Yeah, what I am giving, what I am getting. Good understanding. What is FMV? Value of assets transferred minus liabilities determined as follows. Immovable property, I will take the stamp value. Okay. Investments. Listed, I will take the FMV on the date of transfer. Just now you saw, whichever, if there are multiple FMVs, whichever is higher. Okay, where shares are not quoted on that date, then on the immediate preceding date. Unlisted equity shares, net worth 50 CL, I told you it will be proportionate net worth. Other shares and securities, preference shares, debentures, all those investments, FMV. Jewelry and work of art, FMV. Other assets, book value. The following are not assets: advance tax, refund due, deferred expenditure, and unamortized. Liabilities, book value of the liabilities of the above said assets will be reduced. Okay. However, liabilities will not include share capital, reserves, dividend, provision for taxation, and unascertained provision for bad debts, etc. and all. Okay, this is FMV1, what I give, as he said, what I give, that's fair market value, or what I receive. Okay, what I receive. FMV2, fair market value of the consideration received or accrued as a result of slump sales. Asset transfer for monetary consideration, take the monetary value. Assets which are not transferred for monetary consideration. Okay, if the consideration is immovable property, okay, stamp value of the property. If the consideration is quoted shares, fair market value. Unquoted shares, proportionate value, fair market value. Any jewelry, work of art, etc. Okay, this is what FMV1 or FMV2. questions and try to understand it. Cost of acquisition is net worth of the undertaking transferred. Net worth will be computed by taking the unit's book value of assets and liabilities. Finance Act 21 has said goodwill other than purchased goodwill shall not form part of, or it will be nil. Where the unit transferred is in existence for 3 or more years, the resultant gain is long term, otherwise short term. Benefit of indexation not available. This is the amended provision. How FMV1, what I transfer, FMV2, what I get, whichever is higher is going to be the full value of consideration. Okay, we will continue tomorrow morning with the question and answer. Okay, this is where I am taking a longer time because for everything I need to draft the questions to check how FMV changes. I have drafted 3-4 questions for you so that and the material release பண்ணி தொலைய மாட்டேன்றாங்க இன்ஸ்டிடியூட்ல. So that is also taking a longer time. Especially I'm stuck with one provision of 9B. Okay, apportionment of revalued assets. Okay, if at all we'll keep it at the last. Okay, meet you tomorrow morning to understand slum sales practically also. Read through it once so that you are more clear. All the best, friends.